Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
Everyone's very focused on the U.S. yield, of course. Curiously, we're really not very far off year to date. So I just wanted to kind of call that attention out, which is a good reference point. But the countries that are definitely feeling a much higher rate of change in their 10-year yield is Germany, and specifically Japan, United Kingdom as well. So there has to still be some attention on, and by the way, this is the result. This is a ratio, Germany to the dollar. Look at this parabolic move. Oh, this is on a monthly. Money has rotated in a big way as dollar has fallen and yields have risen, has rotated in a big way to other countries to chase that reward of higher yields. But what I wanted to show you was this big deal. Okay, which country is now the weakest? 10-year yields for the US are definitely an issue when it gets up to about 4.76, 4.8. But right now we're not there yet. So equities can still enjoy a little bit of slack. But UK and Japan, not really. That's harder for them to absorb. So the very long end of the bond market is definitely trading like a kind of a debt reckoning is coming. This is a client post that I sent out. Remember, Bank of Japan has their meeting mid-June, just like FOMC, and they're going to discuss all the things that are important, like yield curve control and more bond buying. So we have some ways to get through until this type of event. And that is another macro event risk because they're going to try and keep that global carry trade alive. In other words, keeping yen down. That helps their economy. So we're going to have to keep that on the radar. It's threading the needle, if you will. The irony is Basent wants them to let the yen appreciate. And when it does, we've seen the damage that can befall, for example, the NASDAQ, when we had the yen carry trade unwind back in August of last year, and NASDAQ fell very quickly with semis and Nvidia. Anyway, long story short, that's still on the agenda of careful. Just careful as we get into mid-June. It's not straight up hockey stick for equities with these incoming macro risks. In the meantime, more hedging. Let's talk about that because I did put some ideas here that I grabbed. UBS is out saying these are definitely strong candidates for outright put hedges. SPX skew supports put spreads. You've got JP Morgan actually saying they like August 25-29 call spread financed by a $16 put sold. You've got houses that are coming in here, JP Morgan. Goldman is saying despite all the positives that we see out there, through positioning, it has not rebounded. There are a few possible explanations, a preference among funds to look down market for alpha. Still, I'm struck by how unenthusiastic most investors seem right now. So we're not talking about the retail money that came in for 3 or 4 billion. We're talking about the hundreds of billions and why they're not buying up this market still. So there are some little caveats here and reasons why it makes sense. And then Nomura coming up and saying S&P average stock IV has decreased, et cetera, et cetera. Long story short, it's cheap. And then my put call ratio that I shared as well, that is basically on a low that typically precedes, not a timing tool, but a few weeks, few months out, you get a very strong elevation in VIX again. I would say in that kind of late June timeframe to July, we'll see another resurgence of VIX. But for right now, these are all some of the reasons that are coming in for the market hedging. Thoughts on that?
Yeah, and I think that's these guys do that all the time. They always give recommendations for hedges. And I agree. I was looking at something on the VIX today, selling some 17 puts to buy some, I think it was 24, 42 halves, right? And I've seen some other trades, some 1x2 trades floating about on Twitter, which I never like because they limit that upside. I don't like trades that can blow me up if things get really ugly. I think if you want, we've talked about it before, if you want hedges, you can just buy that convexity. It's hard to do something for nothing when you're really buying true protection. So I like those trades. I think you can do that upside call spread financed by some downside. Last week, we talked about how IWM might be an interesting place because those higher rates are going to be very difficult. I know you hate those small caps. So that's an interesting place where a continuation of the trends that we're seeing is just going to be increasingly worse for that part of the economy. So I like IWM to probably put spreads at this point. But yeah, I like some of those trades there you were showing and some downside, just basic downside put spreads. Only thing is I would limit at this point. I don't really like callers because I wonder if you could get that sort of sudden explosive move. So I like to the upsides. I like those plays that kind of give you the downside, but maintain the upside just in case. You've got protection nice and cheap where you want it again, generally speaking. And I agree. I think there are a lot of problems out there. I think they will be overcome over the next 6 or 7 months, I hope. And in the meantime, I think it's going to just remain a trader's market back and forth. And so I think you just keep monetizing, pick up some puts. Like I've been picking up leaps, but adding some hedges to them.
What about this chart? Does it give you any confidence in your put hedges or outright? In other words, this is Nomura, and you can see the outlier, right? I mean, it's wow. So not since COVID, second lowest since 2010. When you see these types of big moves in S&P stock IV, for example, does that embolden you one way or the other? Or is it just another data point?
Look, we came off fairly high levels, right? So naturally, with all the flinches, we're going to come down quite a bit as well. So I think on its own, it's interesting. It's always interesting to see, but we are seeing some things that we've never seen before in a way. We saw ranges that we haven't seen since the global financial crisis. So we are coming off some incredibly crazy volatility, which I noticed there was some metric in there you were showing that mentioned S&P vol versus realized, and it was the highest on record. Definitely, we've come off unusually incredible times, and so we're going to see some big crushes in volatility. I think you'd be irresponsible if you didn't add some protection here, just because we are always one tweet away or one Truth Social post away from something crazy moving markets again. I think that's absolutely prudent at this point.
This was the one I was looking for. So this one is the other. So this is put call ratio. It is not a timing tool, but you can see that when it gets way oversold a few weeks or maybe months later, we have some reason for hedging when you want to, not when you need to. That was a chart I was looking for.
Yeah, and really, we had everyone focusing on the puts, and the skew was crazy, and then it's normalized. So now we're in a more normalized environment where you can pick up some downside for a more reasonable price, as well as the implied volatility coming down. So I think it's an interesting play. In fact, I've been playing some long options lately. Of course, in the usual suspects, I picked up some more MSTR. I actually picked up some IBIT because it's a bit like gold versus gold miners in a way. Not the same thing, but if you want exposure to Bitcoin, then go into Bitcoin, ARA, whatever. I know you think you're getting all this beta, but oftentimes you don't. If you want Bitcoin, just get into the IBIT. And so the option's been really cheap there. So what I'm doing is I'm setting myself up with delta long kinds of plays that give me a bailout. So I call it my Vega bailout. So I'm going to position myself long. If I'm right, I'm going to do well, especially in a product like Bitcoin, because if we start to get crazy movement, which we will at some point, if we start to get crazy movement again, then we will see an increase in implied volatility, even to the upside. And those upside calls will really catch a bid as well, because then people are going to feel like they're offside, or they want to grab that explosive potential. So that's always one of the interesting things about having way out of the money calls in this stuff when the skew is compressed, is that you get two benefits, which you wouldn't get necessarily in Microsoft, because as the stock goes up, usually they're just pushing down that upside skew. Those upside calls get compressed. So I always think this is an interesting place to be, especially given all the things that we're talking about. It all kind of points to a lot of uncertainty and a lot of crazy stuff happening below the hood, underneath the hood. And why not have some exposure there? You've got point break. Gold's been I'm a little surprised it was down a little bit today, but
I'm surprised it's not down more.
Not down more. Yeah.
I am. I'm still waiting for it to roll over. But in any case, right now the market is softening into Friday, and probably right in front of Nvidia earnings, a little pensiveness. So I think we have to have that play out first. But yeah, I am bearish semis into the end of the week. Clients know that since Tuesday. Wednesday, we had a little shake and bake, but it's absolutely selling underneath the surface. So I'm comfortable with that ahead of Nvidia. But then after that, I have no idea. Besides, I already got my Nvidia, right? From 96 to 136, I was convinced. But after that, I'm like, I don't know, I don't care. Let's see what happens after earnings.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here, and subscribe to LaDucTrading YouTube channel for more content.